Hey guys, welcome back to my channel. Today we're going to be talking about how stock works. I know that's really creative, right? But it's true. And if you've been following for any amount of time, you probably know that's one of our favorite things to do. We like to take complex ideas that sound scary, but aren't really, and break them down into simple terms so anyone can understand. And today is no different. So whether you're a beginner looking to get started with investing or you just need a refresher on the basics, this video has you covered. Let's dive in. Okay, so first let's talk about what is a stock. Because I know not everyone watching knows exactly what a stock is. Now if you do, feel free to skip ahead by clicking the little chapters icon down below. Now when you buy a stock, you're actually buying a small piece of ownership in a company. When you buy a stock, you become a shareholder of that company, which means you own a tiny slice of the company itself. The reason companies issue stocks is to raise money. So let's say you're starting a lemonade stand, and you want to turn it into a worldwide billion-dollar enterprise. Well, the first thing you're going to have to do is raise some capital to fund your growth because you can't grow the business without it. So you go to investors and you say, hey, if I can grow this to $1 billion, you'll make 10 times your money. The investors say, great, here's $1 million. They give you the $1 million, and in return, you give them a percentage of ownership in the new company that you formed called Lemonade Inc. If you sold 100 shares at $10 each, you would receive $1,000, and in return, these investors would now own 10% of Lemonade Inc. If someone else came along and invested $25,000 and bought 250 shares at $10 each, they would also get 25% of the company. What they're really buying is a small piece of ownership in the company. Now, when you decide to sell your share of the company, you don't sell it to the Lemonade Corporation. You sell it to other investors who also own shares in the company. It's really important to remember that the value of a stock represents a percentage of ownership in a company. So if an investor owns 10% of a company and the company is worth $1 billion, then that person's 10% ownership stake is worth $100 million. Now, let's take it up a notch. Let's imagine that you invest $1,000 into Google stock. Congratulations! You now own 0.0000002% of Alphabet Inc. It's a lot of numbers, I know, but basically, you own a really small part of Google. But why would you want to buy a tiny little piece of a massive corporation? Well, for a few reasons. First off, you get to be part owner of a successful business. That's pretty cool. But more importantly, stocks have the potential to make you a lot of money. See, when you buy a stock, you're betting on the future success of a company. If the company does well and makes a lot of money, then the stock price goes up and you can make a lot of money. By selling your stock, or even better, you can hold on to it and let the compounding interest work its magic. Okay, so let's look at this from the perspective of someone who wants to start a business. Imagine you're trying to open a donut shop. You go to the bank and ask for a loan of $10,000 so you can buy all the equipment you need to make donuts. The bank says sure, but you have to pay us back with interest. Now this is unideal because you're taking on a lot of debt and you have to pay it back whether or not the business is successful. Plus, if the business fails, you might even lose everything. Now imagine instead of going to the bank, you go to investors and you say, hey, if I can make you $1 million, you'll get $100,000. Sounds pretty good, right? The investors say, deal. So you get your $100,000 and you use it to open your donut shop. Business is booming. 1 year later, your donut shop is making $1 million and your investors are thrilled. They made a lot of money and you got to keep your donut shop. Everyone wins. But what if the business doesn't do well? In this case, the investors wouldn't lose anything. They would just lose their investment. So they're actually taking on less risk than if they had lent you the money. In fact, they're taking on no risk at all. The worst-case scenario for them is they just lose the money they invested. On the flip side, the best-case scenario is that they make a lot of money. So hopefully, this gives you a good idea of why stocks exist and why they're so popular. People invest in stocks because they believe that the company will make a lot of money in the future. And if the company does well, then the stock price goes up, and they can make a lot of money by selling their stock. Now, you may be thinking, great, I want to invest in stocks too. And that's awesome. But there's one thing you need to know before you get started. It's important to remember that stocks are risky. Yes, they have the potential to make you a lot of money, but they could also make you lose a lot of money. There's no guarantee that a company will do well in the future, no matter how much money they're making right now. Just because a company is doing well today doesn't mean it will continue to do well tomorrow. For example, Kodak was a company that was founded in 1888. It was one of the first companies to produce photographic film, and it was very successful for many years. However, the company failed to adapt to the changing market, and it eventually filed for bankruptcy in 2012. Kodak was a huge company that had been around for over 100 years. But even a company like that can fail if it doesn't adapt to the changing market. Now, I am not saying that Kodak is an example of what will happen to every company that doesn't innovate, but it is an example of what can happen to a company that fails to adapt to the changing market. If you invest in a stock, you need to be prepared for the possibility that the company could fail. Now, that doesn't mean you shouldn't invest in stocks. It just means you need to be aware of the risks involved and invest responsibly. Now, hopefully, this gives you a good idea of how stocks work. And if you enjoyed this video, please hit the like button and subscribe for more videos like this in the future. Okay, now that you know how stocks work, let's talk about why they're such an important part of the economy. Stocks allow companies to raise money by selling small pieces of ownership in the company. This allows entrepreneurs to start and grow businesses without having to take on a lot of debt. It also allows investors to make money by owning a small piece of successful businesses. Of course, stocks are risky, and there's no guarantee that a company will do well in the future. But if you invest in stocks, you're helping to fund the growth of new businesses, and that's pretty cool. Another benefit of stocks is that they're liquid, which means that you can buy and sell them easily. If you want to sell your stock, you can simply go to a stock market and sell your shares. This makes stocks a great way to invest your money because you're not tied up in a liquid investment. In addition to being liquid, stocks are also very divisible, which means that you can buy a fraction of a share. This makes it possible for anyone to invest in any company, regardless of how much money they have. For example, if a share of Apple stock costs $100, you can buy $20 worth of Apple stock. You don't have to come up with the full $100 to invest in Apple. Finally, stocks are also very easy to trade, which means that you can buy and sell them quickly and easily. You don't have to wait days or weeks to complete a trade. It can all be done in a matter of seconds. So there you have it. That's how stocks work. As you can see, they're a great way to invest your money and help fund the growth of new businesses. So if you haven't already, consider investing in stocks today. If you enjoyed this video, please hit the like button and subscribe for more videos like this in the future. Thanks for watching.